Hello everyone, welcome to the 202nd episode of me learning how to trade in Forex. So in the last episode, we started off looking at how to start Forex trading, a beginner's guide. So we finished off the first part of this series, Forex FX, how trading in the foreign exchange market works. We went through it in the Forex market. Currencies are traded in lots. Micro lot is 1,000 of a given currency, mini lot is 10,000 of a given currency, and the standard lot is 100,000 of a given currency. No central body which oversees the Forex market. For spot transactions, the price is established on the trade date but the money exchanged on the value date. So the forward price is a combination of spot rate plus or minus forward points which represent the interest rate differential between the two currencies. A forward contract is tailor-made to the requirements of the counterparties, which can be for any amount, and settled on a date that is not a weekend or a holiday in one of the countries. Forex futures are derivative contracts which a buyer and a seller agree to a transaction at a set date and price. Forex prices influence global trade as companies buying or selling across borders must take currency fluctuations into account when determining their costs. Forex impacts consumer prices as global exchange rates increase or lower the prices of imported products. Currency values are influenced by a variety of international events such as interest rates, inflation, geopolitical stability, and economic growth. So then we went through the second bit of this guide, I guess. So we got up to how to start trading Forex. Let's get started then. So how to start trading Forex. Here's a to-do list to get you started. Learn about Forex. You now have the basic concepts, but you'll need to understand more of the terminology and how the Forex market operates. This includes learning currency pairs, market patterns, and the factors influencing currency pairs. How to start trading Forex. Learn about Forex. So understand more of the terminology and how the Forex market operates. This includes learning currency pairs, market patterns, and the factors influencing currency prices. So this includes learning currency pairs, market patterns, and the factors influencing currency pairs. Currency prices, not currency pairs, currency prices. Develop a trading strategy. So develop a trading strategy. Learning the different trading strategies such as various technical analysis strategies, fundamental analysis, and news trading. Choose a strategy that aligns with your trading style and risk tolerance. For more, see our Forex trading strategy and education. Learn the different trading strategies such as various technical analysis techniques such as various technical analysis techniques, strategies, not techniques, fundamental analysis, and news analysis and news trading. Choose a strategy that aligns with your trading style and risk tolerance. So choose a trading strategy which aligns with your trading style and risk tolerance. For more, see our Forex trading strategy and education. Yep. Develop a plan. I can't spell. Develop a plan. So create a trading plan that includes your goals, risk tolerance, strategies, and the criteria you use to assess trades. The most crucial part is not just making a plan, but sticking to it in the heat of trading when emotions run high. Disciplined traders are successful traders. Create a trading plan that includes your goals, risks, risk tolerance, strategies, and the criteria you use to assess trades, and the criteria you use to assess trades. The most crucial part is not just making a plan, but sticking to it in the heat of trading when emotions run high. So don't just make the trading plan, stick to it. Disciplined traders are successful traders. Set up a brokerage account. Okay. So set up a brokerage account. Select a broker regulated by a reputable financial authority such as the Commodities Futures Trading Commission in the US. Ensure the broker offers a user-friendly trading platform, good customer support, and low fees. For ideas, see our best Forex brokers. So select a broker regulated by a reputable financial authority. Ensure the broker offers a user-friendly trading platform, good customer support, and low fees. Practice with a demo account. Many Forex platforms include the ability to paper trade before you put your skin in the game. This is a time to ensure you've locked down all the mechanics of trading and test your strategies. It's better to find your mistakes by practicing than when your money is on the line. Use this demo account to ensure you've locked down all the mechanics of trading and testing your strategies. It's better to find your mistakes by practicing than when your money's on the line. Yep. Start slowly. Once you feel confident with your practice trading, start trading with real money. Start off small to manage risk and gradually increase your trading size as you gain experience. Once you feel confident with your practice trading, start trading real money. Start off small. Once you feel confident with your practice trading, start off small. Start off with a small amount of real money to manage risk and gradually increase the trading size as you gain experience. Stay on top of your holdings. Regularly check your positions and ensure you have enough funds in your accounts. Use stop loss and take profit orders to manage risk and protect your profits. So regularly check your positions and ensure you have enough funds in your account. Use stop loss and take profit orders to manage your risk and protect your profits. Use stop loss and take profit orders to manage your risk and protect your profits. Monitor and adapt. Keep up with market news, economic indicators, and geopolitical events likely to affect currency prices. Be prepared to adjust your strategies as market conditions change, which is not the same as adapting your strategy with every price move. Be prepared to adjust your strategies as market conditions change, which is not the same as adapting a strategy with every price move. Be prepared to change all of your strategy, not just adjusting one parameter of your strategy. Is that what they mean? With the market news, economic indicators, and geopolitical events likely to affect currency prices. Be prepared to adjust your strategies as market conditions change, which is not the same as adapting your strategy with every price move. Adapting your strategy. Adapting your strategy with every price move. What does that mean? Adapting your strategy with every price move. Don't know, to be honest. Adjust your strategy, not the same as adapting. But both is like changing your strategy though, isn't it? Anyways, types of markets. Forex is traded primarily via spot, forwards and futures markets. Spot market is the largest of all three markets because it is the underlying assets, the money on which forwards and futures markets are based. When people talk about the Forex market, they're usually referring to the spot market. The forwards and futures markets are more likely to be used by companies or financial firms that need to hedge their foreign exchange risks. So spot market. In a spot market, currencies are bought and sold based on their trading price. Prices are determined by supply and demand and reactions to specific factors. In the spot market, currencies are bought and sold based on the trading price, which is determined by supply and demand and reactions to factors such as interest rates, economic performance, geopolitical events, price speculation. A finished deal on the spot market is known as a spot deal. It is a bilateral transaction in which one party delivers one currency amount to the counterparty and receives a specific amount of another currency at the agreed upon exchange rate value. After a position is closed, it's settled in cash. Trades take 2 days to settle. Okay, so forwards and futures markets. Forward contract is a private agreement to buy a currency at a future date and a predetermined price in the over-the-counter markets. A futures contract involves the same principle but are standardized. Future trades on exchange, not over the counter. In the futures market, futures contracts are bought and sold based on a standard size and settlement date on public commodities market, such as the Chicago Mercantile Exchange. Futures contracts have specific details, including a number of units being traded, delivery and settlement dates, and a minimum price increments that can't be customized. The exchange acts as a counterparty to the trader, providing clearance and settlement services. Futures contracts are bought and sold based on standard size settlement. Futures contracts have specific details, including a number of units being traded, delivery and settlement dates, and minimum price increments that can't be customized. The exchange acts as a counterparty to the trader, providing clearance and settlement services. Both types of contracts are binding and are typically settled in cash at expiry. Although contracts can also be bought and sold before they expire, these markets can offer protection against risk when trading. In addition to forwards and futures, options contracts are traded on specific currency pairs. Forex options gives holder the right but not the obligation to buy or sell a currency pair at a specified price on a specified date. So options, we meet again. Both types of contracts are binding and are typically settled in cash at expiry. Although contracts can also be bought and sold before they expire, these markets can offer protection against risk when trading. Important! Unlike the spot, forwards and futures markets, the options markets doesn't involve an obligation to purchase the currency. Options contracts give you the right to buy or sell the currency, but it's a choice. Using the Forex markets, there are two features of currencies as an asset class. You can earn the interest rate differential between two currencies. When you hold a currency pair position overnight, you'll either receive or pay interest based on the interest rate differential. You'll earn interest if the currency bought has a higher interest rate than the currency sold. This strategy is sometimes called a carry trade. You can profit from changes in the exchange rates in Forex trading. You can profit by buying a currency pair when you anticipate the exchange rate will rise and selling it when you expect the exchange rate to fall. The difference between your entry and exit prices determine your profit or loss. What you can do with currencies basically. Two features of currencies as an asset class. So, two features of currencies as an asset class. Can earn interest rate differentials can earn the interest rate differential between two currencies. So when holding a currency pair position overnight, you'll either receive or pay interest based on the interest rate differential. You will earn interest if the currency bought has a high interest rate than the currency sold. You will earn interest if the currency bought has a higher interest rate than the currency sold. This strategy is also called a carry trade. So can profit from changes in the exchange rate. So can profit from the changes in the exchange rate. In Forex trading, you can profit by buying a currency pair when you anticipate the exchange rate will rise and selling it when you expect the exchange rate to fall. Difference between your entry and exit prices determine your profit or loss. Can profit by buying a currency pair when you anticipate the exchange rate will rise and selling a currency pair when you anticipate the exchange rate will fall. Difference to your entry and exit points prices determine your profit and loss. Yep. Okay. Forex for hedging. Companies doing business in foreign countries are at risk due to fluctuations in currency values when they buy or sell goods and services outside of their domestic markets. Foreign exchange markets provide a way to hedge currency risk by fixing a rate at which the transaction can be completed. Trader can buy or sell currencies in the forward or swap markets in advance, which locks in an exchange rate. Locking in an exchange rate helps firms reduce losses or increase gains, depending on which currency a pair is strengthened or weakened. Types of Forex accounts. There are 4 types of Forex lots. Nano lots are 100 currency units, micro lots are 1,000, mini lots are 10,000, and the standard lots are 100,000 units of currency. Oh, I haven't met nano. Only met micro. So nano is 100 currency units. Right, okay. Forex for speculation, interest rates, trade, political stability, economic strength, and geopolitical risk all affect the supply and demand for currencies. This creates prospects for profiting from changes that may increase or reduce one currency's value relative to another. A forecast that one currency will weaken is essentially the same as assuming that the other currency in the pair will strengthen. So a trader anticipating a currency change could short or long one of the currencies in a pair and take advantage of the shift. Sure. Basic Forex trading strategies. The most basic trades are long and short trades, with the price changes reported as pips, points, and ticks. Ticks. In a long trade, the trader bets that the currency price will rise and that they can profit from it. Short trade consists of a bet that the currency pair's price will decrease. Traders can also use trading strategies based on technical analysis such as breakouts and moving averages to fine-tune their approach to trading. Trade bets that the currency price will increase and they can profit from it. Currency pairs will decrease. Traders can use technical analysis. Depending on the duration numbers for trading, we can set out 4 types of trading strategies. Scalp trade involves positions held for seconds or minutes or at most, and profits are restricted to a number of pips. Day trades are short-term trades in which positions are held and liquidated on the same day. Duration of the day trade can be hours or minutes. In a swing trade, the trader holds positions for longer than a day, like days or weeks. In a position trade, the trader holds the currency for a long period, sometimes months or even years. Forex terminology. The best way to get started in Forex is to learn its language. Here are a few terms to get you started. Forex terms cheat sheet. Ask. The lowest price at which someone is willing to sell a currency. Example. If the Euro USD ask is 1.2345, it's the lowest price someone will sell you €1 for. It's the lowest price someone will sell you €1 for USD. Base currency. The first currency listed in the currency pair. In Euro USD, the euro is a base currency. Bid. The highest price at which someone is willing to buy a currency. So if the Euro USD bid is 1.2345, it's the highest price someone will buy €1 from you for. Bid ask spread. Difference between the buying bid and selling ask price of a currency pair. If the Euro USD bid is 1.2345 and the ask is 1.2348, the spread is 3 pips. So 45, 48, that's 3. Contract for difference, or CFD, a derivative that lets traders speculate on price movements without owning the underlying assets. Trading Euro USD CFDs means betting on price changes, not owning euros or dollars. Currency pair, a quote for different currencies with the value of one expressed in terms of the other. Euro USD, GBP JPY, USD CHF, etc. Leverage, using borrowed capital to increase potential returns and risks. Trading with 100 to 1 leverage means controlling $10,000 worth with only $100 of your own money. The rest is borrowed. Long, buying a currency pair with the expectation it will rise in value. Going long on Euro USD means you expect the euro to strengthen against the dollar. Lot, a standardized unit of a currency traded in Forex. Standard lot is 100,000 units, a mini lot is 10,000, micro lot is 1,000, and a nano lot is 100 units. Margin, the amount of money required to hold a leveraged position. Your broker may require a 5% margin, meaning you have to pay 5% of the total position value in your accounts. Pip, the smallest standard unit of price movement in a currency pair, typically the last decimal place. Pip in Euro USD is 0.0001. Quote currency, the second currency in a currency pair. In Euro USD, the US dollar is the quote currency. Short, selling a currency pair with the expectation it will decline in value. Going short on GBP JPY means you expect the pound to weaken against the yen. Yep. So charts used in Forex trading. 3 types of charts are used in Forex trading. Line charts. Line charts are used to identify big picture trends for accuracy for a currency. Line charts are used to identify big picture trends for currency, for a currency. They're the most basic and common type of charts used by Forex traders. They display the closing trading price for a currency for the period specified by the user. The trend lines identified in a line chart can be used to advise trading strategies. For example, you can use information in a trend line to identify breakouts or a change in trend for rising or declining prices. Important. Remember that the trading limit for each lot includes margin money used for leverage. This means the broker can provide you with a capital at predetermined ratio. For example, they may put up $50 for every $1 you put up for trading, meaning you only need to use $10 for your funds to trade $500 in currency. Yep. Bar charts. Like other instances in which they are used, bar charts provide more price information than line charts. Each bar chart represents 1 day of trading and contains the trade's opening, highest, lowest, and closing prices. A dash on the left represents a day's opening price, and a similar one on the right represents the closing price. Colors sometimes indicate price movement, with greens or whites used for rising prices, and red or black for periods during which prices declined. Bar charts for currency trading helps traders identify whether it's a buyer or a seller's market. Candlestick charts. Japanese rice traders first used candlestick charts in the 18th century. They are visually more appealing and easier to read than the charts above. The upper portion of a candle is used for the opening price and the highest price point of a currency, while the lower portion indicates the closing price and the lowest price point. Down candle represents a period of declining prices and is shaded red or black, while an up candle is a period of increasing prices and is shaded green or white. The formations and shapes in candlestick charts are used to identify market directions and movements. Some of the best known are the hanging man and shooting star. Pros and cons of trading Forex. Pros: largest in terms of daily trading volume in the world, traded 24 hours a day, 5 days a week, starting capital can rapidly multiply, generally follows the same rules as regular trading, more decentralized than traditional stock or bond markets. Cons: leverage can amplify losses. Leverage in the range of 50 to 1 is common. Requires an understanding of the economic fundamentals, macro factors and indicators. Less regulation than other markets, and no income generating instruments. What does that mean, no income generating instruments? So something which automatically generates you income? Is that what they're saying? Pros explained. Forex markets have the largest daily trading volume globally and thus the most liquidity. This makes it easy to enter and exit position in any major currency within a fraction of a second for a small spread in most market conditions. The Forex market is traded 24 hours a day, 5 days a week, starting each day in Australia and in New York. The major Forex market centers are Frankfurt, Hong Kong, London, New York, Paris, Singapore, Sydney, Tokyo and Zurich. The leverage available in Forex trading means that a trader's starting capital can rapidly multiply. Forex trading generally follows the same rules as regular trading and requires much less initial capital than the other forms of trading. The Forex market is more decentralized than traditional stock or bond markets. No centralized exchange dominates currency trade operations, and the potential for manipulation, though through insider information about a company or stock, is lower. No centralized exchange dominates currency trade operations, and the potential for manipulation through insider information about a company or stock is lower. Fares. Cons explained. Leveraged trading amplifies losses in Forex trading just as it amplifies gains. Banks, brokers and dealers in the Forex markets allow a high amount of leverage, meaning traders can control large positions with relatively little money, increasing the risk of catastrophic losses. Leverage in the range of 50 to 1 is common in Forex, though even greater amounts of leverage are available from certain brokers. Still, leverage must be used cautiously because many inexperienced traders suffer significant losses using more leverage than necessary or prudent. Trading currencies productively requires an understanding of economic fundamentals, macro factors, and indicators. A currency trader needs a big picture understanding of the economies of various countries and their connections to grasp what drives currency values. A currency trader needs a big picture understanding of the economies of various countries and their connections to grasp what drives currency values. Forex markets are decentralized, which means they are less regulated than other financial markets. The extent and nature of regulation in Forex markets depend on the trading jurisdiction. Forex markets lack instruments that provide regular income, such as regular dividend payments. Right, okay, I see. Forex trading versus investing. Investing and trading are two distinct approaches to participating in financial markets, each with different goals and strategies. Investing typically involves a longer-term approach where the goal is to gradually building wealth over time. Investors may hold assets for months, years, or even decades, aiming to benefit from the appreciation of the asset's value or regular income through dividends or interest payments. Meanwhile, trading involves a shorter-term approach aiming to profit from the frequent buying and selling of assets. Traders seek to capitalize on short-term price trends and may hold positions for a few seconds, scalping, minutes, hours, day trading, or days to weeks swing trading. They are often rely on technical analysis, studying charts and patterns to identify trading prospects. Forex trading is far more common due to the market's high degree of leverage, liquidity, and the 24-hour accessibility. Forex traders typically use shorter-term strategies to capitalize on frequent price fluctuations in currency pairs. Forex scams, frauds, and hucksters. Forex trading scams are fraudulent schemes that prey on unsuspecting traders and investors in the $7.5 trillion per day foreign exchange markets. Charlatans exploit the market's complexity, high stakes, and lack of centralized regulation to deceive victims, often with false promises of easy profits and low risk. Over the years, common scams have included Ponzi schemes that misuse investors' funds and scams, peddling worthless trading advice. The Forex scandal of 2013, in which traders at some of the world's largest banks colluded to manipulate exchange rates, highlighted the potential for large-scale fraud even among established financial institutions. The Forex scandal of 2013, in which traders at some of the world's largest banks colluded to manipulate exchange rates, highlighted the potential for large-scale fraud even among established financial institutions. The scandal led regulators to ramp up scrutiny in the area. However, given the many scams since, vigilance is undoubtedly called for. Here are some of the best-known recent Forex cons. Forex scandal, Forex probe, 2007-2013. Banks colluded to manipulate exchange rates on the Forex market for years. Key players: Barclays plc, JP Morgan and Chase & Co., UBS Group AG, Citigroup, and others. Black Diamond Ponzi Scheme, 2007-2010. Ponzi scheme promising high returns from Forex trading, which never took place. American fake hedge fund managers. IB Capital FX scam, 2012. A Forex scam that solicited funds from at least 960 customers without proper registration. Unlicensed Forex traders. FXCM, 2009-2014. Among myriad allegations of fraud, the CFTC banned the company from trading in the US since it was secretly involved in betting against its clients' trades. FXCM, now called Stratos, which says it no longer takes US clients, is now a subsidiary of Jefferies Financial Group Inc. Where FXCM, I think I've heard of that before actually. Among Among myriad allegations of fraud, the CFTC banned the company from trading in the US since it was secretly involved in betting against its clients' trades. FXCM now calls Stratos, which says it no longer takes US clients. It's now a subsidiary of Jefferies Financial Group Inc. Israeli-German Forex scam 2023. Oh, that's recent. Police allege the suspects pose as financial traders dealing in cryptocurrencies and Forex, targeting individuals worldwide through call centers in Bulgaria, Serbia, Ukraine, Georgia, Kosovo, and Israel. German nationals and Israeli crime syndicates. Well, this is like 7 years. That's a long time, that is. 6 years. Anyways, these are only some of the frauds in this area of finance. Here are common types of scams. Signal call scam, signal seller scams, fraudsters selling trading signals or advice, often with false promise of guaranteed profits. High yield investment programs, scammers lure in investors with promises of high returns from non-existent or worthless investments. Fake brokers, unregistered offshore brokers manipulating the trading conditions, refuse withdrawals or disappear investors' funds. Automated trading systems. These scams involve selling Forex robots that the cons claim can trade profitably on behalf of the user, but often result in losses instead. Social media and messaging apps have been used in these scams. Some involve fraudsters building romantic relationships to gain trust before introducing Forex trading schemes. Interesting. Tips on avoiding Forex scams. Experts emphasize the importance of education and due diligence in mitigating the risk of falling victim to scams. Here are some tips. Verify broker credentials. So, ensure that the broker is registered with the reputable regulatory bodies like the CFTC or FCA. Check their regulatory status and history of compliance. There are just 6 CFTC registered Forex dealers in the US. Avoid trading with any others. So I'm guessing these are the 6. Charles Schwab Futures and Forex LLC, Gain Capital Group LLC, Forex.com, IG US LLC, IG, okay, Interactive Brokers LLC, Oanda Corporation, Oanda FXTrade.com, Trading.com, Marquez Inc., Trading.com. Be skeptical of high returns. Avoid investment prospects that promise guaranteed high returns with little or no risk. Legitimate investments always have risk, and reputable brokers front the risks for you to ensure you understand what you're getting into. Do your research, investigate the company, its management team, and its track record. Look for reviews and testimonials from credible sources. Be aware of common scam tactics like fake accounts, impersonations, and misleading marketing materials. And choose brokers with transparent fee structures, clearly defining trade conditions and accessible customer support. Use security tools. Employ VPNs, password managers, and antivirus software to protect your trading accounts and personal information. Forex fraud will likely become more innovative as markets evolve and sophisticated technology tools enable ever more complex con jobs. But with constant vigilance, robust regulation and security, and prudence, Forex trading can be navigated more securely. Okay, I'm going to leave this episode here then. Peace.